It's fabulous numbers. It really is. On top of that, over the quarter, the Treasury yield stopped going up as well. So you had, Goldilocks kind of growth, where growth accelerated without interest rates moving up, at least on the long end. So fabulous first half, fabulous second quarter, and it's starting to feel, Carl, a little like prior to 2008. The old type recovery around 3% growth. I think the problem is we're finally getting, good growth at a time when the unemployment rate is 3.9%. And if we keep up at anything close to 4% growth in the rest of this year, I just got to believe you're going to push, CPI inflation, wages, the 10-year yield all above 3%. And we're going to be struggling a little bit with good growth, but maybe too good. On the other hand, if we slow down a little bit, which I think is more likely, then you're going to see calls and recession worries, I think, elevate. So I do think the market is still going to have a struggle finding this silver lining Goldilocks path, because you could get either too hot or too cold in a hurry here this late in an economic cycle at full employment.
Jeff, that runs counter to another narrative that we're hearing a little bit more of this week, and that is that there'll be an easier Fed in 2019. You look at December odds, you look at Powell's speech last week, you look at what Paul Tudor Jones has said about a potential run-up or melt-up in Q4. Do you lean one way or the other?
Well, I think that the Fed is clearly going to be data-driven, and as Jim just talked about, the data is pointing to further moves from the Fed. For me, one of the most interesting and reliable indicators of when we're at a point in the cycle where you really need to begin to worry about the peak is when the inflation rate and the unemployment rate are the same number. That preceded every one of the last three recessions by about a year. They're still 1% apart right now, but could close that gap fairly quickly under fairly rapid 4% growth.